Well, good afternoon. Happy Friday, everybody. I'm your host, Peter DeRosa, here on Main Street to your street, and my co host, Ken LaMantia, joining me here.
Hey, how's everybody doing today on this wonderful day?
Look, Ken, I'm excited. Last week we had a lot of fun and really got excited about this week and being able to talk about some more history. But this week we're going to kind of shift it more to your wheelhouse. We're going to talk about the history of investing in securities. And this is going to be, we want to make this really clear to everybody. We're not giving investment advice. Right, we're not here to do that. We're here to educate. We're here to provide some entertainment, but we're going to spend a lot of time talking about where all these things came from, the terms, we're going to talk about some stories from the industry, and we're going to have some information that's important for the average insurance agent or financial professional, or yeah, hey, even consumers being able to laugh and learn about this information. Anything else you want to let us in on, Ken, before we get this going?
No, I just want to jump into it. Let's get into it and have some fun.
All right. Let me pull up the screen here. So I like to start with a great quote, and I feel this is really the direction that we're going most of this information today. An investment in knowledge pays the best interest. And I've heard that over the years, and it really is true for the agents who spend the time, the financial professionals who spend the time to learn. There's nothing disappointing here. The more that you understand, the more you find out that you don't understand in this business. And but it's important when you have to sit down and explain to people their questions. People come from all different arenas and have different questions based off their experiences. And having the knowledge really does make you confident and competent in being able to provide the best solutions for the consumer. Would you agree with that, Ken?
Absolutely.
Let me move on here. All right, we're going to move on. So a lot of this information, some of it comes from Forbes and other places as well. But we're going to go back right back to the dawn of time, right? From the Code of Hammurabi back in 1700. They had the first contracts, the first literally investment contracts, the legal framework and guidelines for investments, all the way back in 1700 BC on grain contracts, right? This whole form and system of what makes the world turn around, investments, right? This has been going on a very long time. There's nothing new here under the sun. In the early 12th century in France, a system was created to manage and regulate the debts of agriculture and farmers on behalf of the banks. The men who traded these debts were dubbed brokers, right? By the 13th century, the Venetian bankers began to trade in government securities. And the now famous Dutch East India Company was founded 2 centuries later and became the first joint stock company to get a fixed capital and allowed for the first continuous trade investment in company stock through the Amsterdam Exchange. So I know that's a whole lot real quick. We want to really skip to the modern times, okay? So really the idea, the concept of a broker comes in the 12th century, and then the Venetians immediately increase that to the next tier and banking, and then we have the first exchange in Amsterdam. So real briefly here, Ken, and I'll let you take it over. Investors were commonly called speculators up until the 1900s. Because when we do the research and you look up the definition of speculation, it's very different than investing. Very different. And then because a lot of people didn't like well, quite frankly, what it says in the dictionary, a speculator is, they morphed the word, the terminology, they changed the meaning to investing. So that by the 1950s, everybody who was involved with the stock market called themselves investors, where in the past they would have called themselves speculators. What do you want to talk on that topic about, Ken?
Well, when we're talking about history about this, you notice that there's a very small percentage of the population invested in the market. That is by design also. How do you manipulate the country's wealth? Hey, you keep out the small guy. How do you do that? By regulation. This continued on all the way into the 80s, where they had this thing called the qualified investor. If you weren't a qualified investor, you couldn't get into IPOs. You couldn't get into certain investments. And you couldn't have access to some of the market information that was that brokerage firms would give you. And so people have to understand things haven't really changed as much as we think they have. It's all about the perception and understanding.
That is so true. Perception is reality for a lot of people, and what they're not aware of is the changes in our vocabulary that they do make a difference, folks. If you look up in the Webster Dictionary what a speculator, basically somebody who hopes to have a commensurate gain with their investment, meaning, for the amount of risk, the more reward, right? That's everybody who rolls the dice in a casino and everybody who invests on the stock market, right? The more risk, the more reward. Whereas an investor is somebody who put money, by definition, was somebody who put money into an investment that would expect a guaranteed or return on that money, right? There was no risk involved. So it's very different. And now when we talk about investors in the stock market, well, you still hear the more risk, more reward when they talk about investing now. So it's a very different terminology and understanding. But going back to the early days, once again, the French word broker came from those who were the middlemen who were dealers and goods and stuff. And dealers were the people who delivered, right? So they delivered the contracts, the goods, to the syndicates warehouses, basically the people who underwrote the contracts, right? So today we have people who are broker dealers, right? They do both the monetary and the physical delivery of contracts. Do you want to mention anything about that, Ken?
No, if you think about how this started out, this is more in the commodity realm. Yes, it is investing, but today we would call that commodities because we're trading on cocoa, wheat, flour, things like that, beef, and these are called commodities today. But the original version was like they said, it was their form of securities.
So let's go real quickly here, and the first London exchange. Most of the people met at coffee houses. There's a lot of deals still done in coffee houses to this day. A lot of bars too, right? And it's interesting if you go back and you look. Um, a lot of the early brokers would gather at bars, and so becoming someone who was a coffee house owner or somebody who was a bartender or innkeeper, literally transacted. Stock business happened on your premises. That's why it was such a respectable occupation to be a bar owner. We go back to the earliest actual exchange. It's the Buttonwood Agreement in 1792 to formation of the New York Stock Exchange. So we've had an exchange in this country since 1792. And I just want to move it up a little bit here. We had some really great opportunities in this country, but like Ken spoke of earlier, those opportunities were limited to just those who had access through their wealth to those markets. Sometimes it meant you had to live in one of those cities where the actual activities were happening. So you had to live in Amsterdam, you had to live in New York in order to access the exchange, you had to live in London, and a lot of those requirements for collateral or the amount of money that they had to invest to become a qualified investor, they stayed on the books all the way up until 2012, where under President Obama, under the Job Act, they actually changed the solicitation and allowed for entrepreneurs and the public to share in those initial, the IPOs and the initial offerings. So, I mean, we're talking, literally from 1933 until 2012. It really kept people out of these extraordinarily risky startups and ventures, and only allowed people who really had a considerable amount of collateral to invest in those upstarts. Anything you want to add to that, Ken?
Yeah, it got so bad you have to have a liquid net worth of $100,000 just to get into an IPO or speculative investment. And again, that's why they made the change because what they found out, most of the qualified investors weren't qualified investors. They had leveraged so much of their trades and their portfolio that they actually weren't worth $100,000 liquid. And then it wasn't fair. And then it came up, and you got to remember, before there was FINRA, there was another organization, and it just went right out of my head. Oh, the NASD. And the NASD was a very interesting. The way they regulated was more for where the big money was. They didn't regulate everything. Then FINRA came into place because they found out how crooked and how bad things were going, and that happened after 2008. That really caught up and bit them right in the butt. So there is an evolution of how they are regulating now and how it's more fair. And now it's jumped to today. You have to understand it morphed into people, individuals, brokerage firms, and then they created AI, which changed the whole game. It is almost to the point where you cannot regulate it. It moves so fast, which is a little
Wow.
scary.
Yeah. So moving on here. So let's talk a little bit about what got the American public into the stock market. And a lot of people don't understand the effects of war in the economy. And I just want to take a moment to talk about this. So, the history, if you take the time to read about it, Citibank um, actually was the bank that was commissioned by the US government to sell war bonds. And the first time they sold war bonds, obviously the Spanish American War, but then immediately following, really World War One. And in World War One, they sold millions of dollars, and we're talking 10, 20, $50 war bonds that matured, with the success, right, and the armistice. But what that really did, and a lot of people don't understand this, is before that, in order to invest inside the market, like we talked about, you had to be on site, you had to go to the exchange, you had to be a qualified investor, but the rules changed. The rules changed because the Citibank made the argument to the regulators, hey, they're already buying securities, they're buying bonds. So they let them in, they let the American public in through a loophole. The bunch of non qualified investors now had access to the stock market. And we're talking immediately following World War One. Can anybody think of anything historically that happened between World War One and World War Two? About the Roaring Twenties? Anybody?
Huge growth. Just at that time, people started understanding how to make money in the United States, individual people. And they also found out how the markets and just local governments were so crooked. And it was just a great time in one hand, but it also exposed the manipulation that was going on since the
Yep.
start of our country.
The artificial inflation and manipulation of contracts. If you do any research or spending time reading documentaries or watching documentaries, reading different books on the topic, I mean, basically from 1917 all the way up until 1929, you could literally throw money anywhere in the U.S. stock market and it would go up. Why? Because we had 120 million Americans at that point in time all of a sudden introduced to the stock market in a period of about 10 years. Now they had a place to go put money in. Not everybody did it, but a lot of people did. And they were taking money and, boy, hand over fist. It didn't matter where you went and you did it. I mean, there were so many opportunities in the roaring 20s between the agriculture, between the insurance. Just what an incredible time it would have been to be alive and to see all those things. And I remember talking with my grandparents about what it was like and all the things that they saw and the changes in their short period of time. It was just such an incredible period of time. I feel like we're living in that same kind of time now here with AI and all the changes that are happening so quickly, like you're talking about, that we can't keep up with. The actual regulations can't even keep up with the speed with which gray activity is transpiring. We'll just put it that nicely, right? But I think the big part that a lot of people don't understand is, well, it did come to an end. We had an end in 1929, right, where Wall Street crashed. There's a lot of reasons. We could spend a whole episode. We might do it another time, going into the depression, what caused it, what the outcome was, and who got through and why, and what was the success, formula to get through. But what I want to focus in on is after that, we had a lot of changes. 1933 going forward, and a lot of those regulations began to impact how people could access the market, how their money, what they could invest in. And then we had a lot more what we call institutional investments that were then put into place. And uh, you want to open up that topic a little bit there, Ken?
Yeah, that's when we came with the Investment Advisors Act, which changed the game completely. They actually started regulating, and they were really serious about it, how to regulate, how to keep people from getting ripped off, how they came up with all these different rules. And one of the things that they realized, I have a great story about this. John F. Kennedy Jr.'s father was very wealthy. He was a bootlegger, but he had a lot of money, and he put a lot of money in the market. But him and a lot of his wealthy friends would manipulate the markets by simply buying puts. Well, what they would do is they would force companies' value down. And then when it was down, they would all come in and buy that stock and it would go up. And they saw a trend, and the government they got they finally figured out something's going on. How do these guys keep making money on every damn trade that they did? So they found out that it was a conspiracy. They pulled them aside and say, look, either you tell us how you do it, or we're going to, prosecute you. This is how they came up with the uptick rule, meaning if you buy a stock and it's on its way down, you can't buy it again going up. It has to tick once. So you couldn't get the manipulation factor. Other people had the time to invest in it. And that changed the game completely. And that is one of the great things that we've learned from history about paying attention to detail. And it was one guy who figured that out. And the guy was brilliant. One guy figured that out. So
That's a great story, Ken. Thanks for sharing that with us. I know. Going from the time of 1930s all the way through World War II, there was a whole lot of things that happened, and we're going to do a special segment on taxation, World War II, and all that in the future. But right now, let's move forward as we're covering history here. Right, we're going to go up until the 1978, the Revenue Act of 1978, which created the 401k plan. Well, why is this important? Because we were just talking about institutional investing and changing the face of things from 1933 on. And literally, it took until we got to 1978 for these newfangled inventions, 401k plans to be created. And what was a 401k plan? What was the original intent and purpose of a 401k plan, Ken? Can you go over that real quick?
it was actually just a supplement to help people invest, get tax deferred growth, and it qualified plan. And it was just for a supplement because everybody had pensions, but something happened as time went on. Pensions could not keep up. They couldn't get the returns to pay off their pension years. So the government being the government and big business being big business, they said, you know what? We're going to shift the liability from the company onto the individuals. So now they can invest in anything they want. And this would give them the illusion of you get the market, your choice, and you control it. What they didn't tell everybody was since you don't know how to invest, is a huge learning curve. And the second thing, they didn't take into the cost. This is how big brokerage firms manipulate it again. Hey, you can have your 401k. We're going to help you with it. We're going to help you grow. Oh, by the way, we're not going to tell you how much it costs in a 401k.
Hmm.
And it turned out to be 5%.
We're going to talk about that in a second here for sure. We're going to have to do a whole video on fees, but let's talk about the lost decade here. So, a lot of analysts, a lot of people will review, the decade of 1970. The stock market didn't do better than a 3.5% return for the entire decade. But yet we see at the end of that period of time, 1978, with the introduction of the 401k plan and the change within the current administration, um, two very big changes that we had this incredible effect. Once again, just like we had all this drop in of money, new money that had never existed in the market space before, with the advent of bonds, from war bonds to securities, right? With the American public, now we have a new introduction, new influx of money, right? Have all this new money that had formerly been going into qualified pension plans now is being introduced into the stock market, billions and billions of dollars over the next 20 years. And when we compare the market performance from 1960 to 1978, it's monochromatic. It's moving up, but very little bits at a time, right? We hit 1978, 1979, 1980 with just like taking off. And it went almost straight up between there and 19, what was it, 1987?
Yep, right about there when the stuff hit the wall, as they say.
Well, and obviously a lot of that, we're not going to spend a lot of time talking about today, but a lot of that had to do with the investment of the Japanese economy and their overall performance in bonds. And there's a whole lot of reasons why on that, but that really influenced, the crash in our markets. Um, but going forward, for a lot of people, their performance in their 401k plans have been very different from, let's just say, the mid 90s to present. Even though the market itself has been up substantially, their performance in their overall, the underlying performance of their 401k plan has been mediocre at best. So let's talk about that for just a minute. I know you brought up the whole fees situation, and I do want to talk about that. But yeah, let's just unpack that for a second.
Okay,
Again, $100,000 portfolio. Start with that.
okay, $100,000 portfolio. What you have to understand: one, you get a 401k, what it's invested in. This is the key factor. When they came up with the mutual fund, it was for pure diversification. And it actually worked in the beginning. It really did. Then greed came in and they started doing mutual funds by sector instead of for real diversification. It's called horizontal and vertical diversification. These guys thought they were smarter than everybody on the block. And when they changed the mutual funds, when they worked, when the market was good, they worked great. The problem was when they went down, they were slow to recover. Time value of money thing. But also when you take in the fee factor, this is what really hurt them. This is what really is the dirty little secret with 401ks, why people don't understand. If they would have used, instead of using just mutual funds and used indexes inside of a 401k, it would be very different. They should also take away the fee structure, how it works now, because it doesn't benefit anybody but the brokerage firms, the guys running it. Because at 5%, how many times do you get a 5% return? Even if you got a 7% return, you got to understand something. All the institutional money is getting wealthier and they're investing more. And the people who are in these 401ks, first of all, you're limited by how much money you can put in, which also you got to take this in numerically, mathematically. If you can only put in a certain amount of money every year and you're getting this huge fee, and when the market goes down, it takes so long to recover, it's a losing prospect. If you were to just take that same amount of money in a portfolio, let's say a bond portfolio making 3%, you would outperform that every single time. That is why a 3% return will outperform a 3% constant return will outperform the S&P 500 all day long.
It's very interesting. Let's talk a little bit more about the fees because I think it's worth spending another minute or two on this. So let's say you got a portfolio of $100,000, and let's just, for simple math's sake, say it's a 4% a fee, right? So at
Mhm.
a 4% fee. Now, let's say, um, you know what? Let me back that up. Let's say it's $100,000, and let's just go with a 1% fee, just for conversation's sake. Okay, 1% fee. There are some people who have TSP funds. Some people that have, certain government or state pension plans where they've got a fee of 1%, right? Well, I'm only paying 1%, right? Okay, so we've got a $100,000 portfolio. We've got a 1% fee. Now, your return for this year is going to be 4%, hypothetically. Okay. What percentage is 1% of a 4% return, Ken?
It's 25%.
What? 25%?
Yes, it is.
You mean I paid 25% in fees?
That's the dirty little secret right there. People don't understand. And here's another thing that you got to understand. Yes, it was $100,000 originally. Now it's worth, on paper, 103 or $104,000. Now that 1% is going up incrementally.
Correct.
So your 1% fee is actually increasing. And because people don't use calculators anymore, they don't get and understand. You're constantly paying more as you go along.
So I just wanted to bring that up as a percentage so people can understand. A 1% fee on a 4% return equates to a 25% effective rate cost for performance. Now let's go back to your 5% return. We got a 5% return, folks. 5% return on $100,000. And your management fee is 5%, according to Mr. Ken.
Yeah.
How much money did you actually make that year?
You actually, this is where it gets incrementally worse. Okay. Your return, let's say you got a 5% return. Your fees are 5%. Now you would think it's a wash, right? It's not. Why? Because of those fees, they degrade your principal at the same time. So again, you have to take that into account. Time value of money. That 5% fee to make that up is not 5%, is it, Peter? It
Nope.
gets incrementally more expensive. This is what they call time value of money and what people do not understand. So, one of the things that I think we should make people understand is we know this in our business because we were taught this very early. If you have a 5% loss, to get back where you were, it's not 5%, Peter. About how much is it? It's not, it gets up incrementally more as you go along. But if you want to get back where you were from that loss, it's 9% just to get back where you were, which is almost double the amount of money. You got to understand that's bad in 1 year loss. But what happens if you have 2 years in a row? Now it's not just times two. It doesn't work like that. Now it's times four, the loss factor.
Now
So
let me, and I that is so important for people to understand that time value loss of money. Absolutely, Ken. I'm sorry for interrupting. Continue.
no, please.
No, I was gonna say, just for sake of math, because I'm now going to have some people say, "Oh, well, I make more than 5% in my portfolio." Let's have that conversation real quickly here. Let's say it's a 10% return, Ken, and we'll be generous. A 1% fee. It's still a 10% cost to your portfolio.
Yes, it is. That's again, that's because people don't understand and they don't read the fine print.
Mm.
They just think in whole numbers of, hey, I made 10%. I only got a 1% fee, but that's only, you know, that that's 10%. That's a 10% fee that you're not making, which doesn't sound that bad. Now, do that over 25 years. You don't have idea how much money that 401k has cost you. You should have $1.5 million, but you know what you end up with? 400,000 or 300,000. Why? The fees are eating you up. And that's if you have all gains. What happens if you have a loss? Now let's talk about that. Let's just say you have a 3% loss. Let's use that same factor, Peter. You have a 5% fee on the 401k, then you have a 3% loss. Let's talk about that. That sounds like an 8% fee, right? What is it really, though, in real life? You got to understand your principal has eroded and you have that fee on top of it. So your purchasing power has decreased by that factor. And you have to take that into account. Do that once is bad. Now, we know, Peter, over time, you're going to lose at least every 10 years, you're going to have 2 negative years, right? At least. That's in a good 10 years. Some years, you're going to have you're going to get beat up a lot, up to 4 times. This is why you have to understand when you invest money, why you're so frustrated. Hey, I've been putting money away for 25 years. You have how many times people have spoke to you, Peter, when we're doing the Fed program, and they said to me, "Yeah, I've been putting money away for 10 years, 20 years, and I have $350,000. How come?" Think about that. Think about how much money they actually put in and how much money they actually have. The biggest factor that people, and I don't want to delve into this too much, is people think this 401k is this magical instrument. You just put money in it and it makes money. That is the biggest misnomer in the world. You have to be proactive. I'm going to tell you something that 90% of the public does not know. Inside of a 401k, there is an escape valve. It's called either a money market, a fixed account, or some of them had bond funds earlier. And this was a way to take your money out of the market and put it to the sidelines so you wouldn't incur major losses. Some people call that timing the market. It's actually common sense. People, if they just follow the simple rule. Here's another thing about people investing that just drives me crazy. When you invest your money and you have a gain, you are supposed to, this is what they teach you in school. You take 25 or 50% of that gain and put it to the sides, which would be the money market or the fixed account, and let that fixed account grow. So if you have a 5% loss, guess what? You got that money over here in the gains that's going to negate that over time. Now, if you did that strategy and you saw the market starting to get beat up, you put your money in the fixed account, you already have your gains in there too. The market gets hit, it starts going up. That's when you put all your money back in. Then it goes up and you do the same thing over again. When you have 25 or 50% gain on that, boom, take some profits and put it to the side. If that simple rule, if people actually did that, there would be no losses in the market. Literally none. But people don't do that. Why? Let's explain. Talk to them why. Why don't they do that, Peter?
Well, I appreciate that example that you gave there, Ken. And a lot of people don't understand as we're talking here. We're giving examples and we're giving testimonials of what we've experienced, what we've read. Because the government did change in 2008 after the financial crisis. They did change the rules regarding disclosures. But the companies, let's be honest, they found a way to bury this in what they call the prospectus. They bury this information, and a typical prospectus is between 66 and 105 pages long. So the information is there. It just takes people like Mr. Ken and myself to sit there and read through all of it to find the information, but it's all there, folks. And so I appreciate that example. A big reason that people don't understand why the 401k plans are not working is this little thing called a benchmark. And I want to talk about this and why it's important to qualified accounts, because a lot of people don't understand that these companies, right? And I don't want to get into too much with this with the company names, but we'll just pick on well, we won't pick on them. We'll just mention them. Fidelity, right? One of these big institutional investors that makes up about 60% of 401k plans are held in Fidelity. Listen, in
Yep.
order for them to manage that money, there were some rules set up. And I'm not arguing with all the rules. The rules are good. They're fine to have the rules in place for how they want that money managed as a fiduciary. But they set these things called benchmarks. And actually, Forbes did an excellent article talking about this. What is a benchmark? Well, that's the amount of interest. And we're going to use an index as an example. They're going to pick an index, S&P, NASDAQ, New York Stock Exchange, whatever the index is, MSCI, as an arbitrator of how we want the average performance of the portfolios of all of our people to make. Well, when they set those benchmarks, their average performance, according to the benchmark, is a little over 3.5%. Well, what does that mean? Translate it to English. That means, folks, that the average 401k, where you can put the money in and forget about, not worry about it, is basically designed to make about 3.5% return. If it makes more than a 3.5% return, then it's considered too risky of an investment based on the portfolio, the blend of the portfolio. It's considered too risky. So the institutional investors came up with this, arbitrary benchmark to determine, okay, how much risk is appropriate. And I'm not arguing with that. I just want people to understand, because a lot of people don't. They don't understand, well, when they put together these different mutual funds, or they put together these different opportunities to invest within the 401k plan, like who decides which stocks get to go in there? That's what we're talking about here. That has more to do with the benchmark than anything else. And so when we talk about this, and I'm just going to cover this real briefly here, a passive benchmark versus a custom. So when we look about, how do most companies review this? A passive is kind of like a put the money in and forget about it. That's 90% of people who do 401k plans. So most of those accounts will use a passive, a PB benchmark to determine, okay, this is for the people who are just going to throw the money in there as intentional and institutional investors and not actively manage their portfolios. We don't want them to get hurt, so we're going to put the average risk at X factor and the average performance at Y. But let's face it, folks, if your fees, like Ken talked about, are 5%, but the average that you're going to be allowed to make is 3.5%, is it going to be pretty hard to have a super funded retirement account that delivers the retirement that you thought you were going to have at the end of 20 or 30 years? The answer is yes. It will be very challenging. Not impossible, but very challenging. Small percentage chance of success. Would you agree with that, Ken?
Yes, and there's a reason why. I want you to understand something. In 2008, after that crash, Fidelity, BlackRock, all these big brokerage firms got together. They got sued left and right. So they said, we got to negate this. There has to be a way for us to stop this, because before that, there was a rule. If you're an investment advisor, either an institution or an individual, there was this thing called know your client rule. And you couldn't put your client into something that was not in their best interest, and it had to fall in within the guidelines. And that cost them. They got sued big time. And it also changed the way brokerage firms and Fidelity and BlackRock, they got together and they literally went to the government and said, hey, we can't afford this. So let's do this. Inside these 401k plans, instead of us giving them advice, let's let them pick whatever they want. This way they can't complain. That wasn't the reason why they did it, because they had the liability from the know your client rule. They got all this money that came in talk to government regulators, convince them this is a better way to do business. And basically, all they did was take all the liability away from the brokerage firms and the investment companies and put it on the individual. It was the biggest, most horrible thing that ever happened in modern history.
Hmm.
Nobody talks about it.
Nope.
They don't talk about it.
Where do
That's
they?
why when you call up about your 401k, what do they say to you? Hey, there's 16 different uh, allocations you can put your money in. Pick one. Well, help me. We're not allowed to. Wait, you're an investor. I give you my money. I pay you for to do this. No, we changed that rule.
Yeah, and if you want the actual investment advisor to manage your account, there's an additional fee for that now, isn't there, Ken?
It's, believe it or not, it's 2% and above now. When I was active in Wall Street, you're lucky if you got 1%. You had to really justify that. Now it's up to 2%. When Peter says fee, you got to understand what that actually means. That 2% keeps increasing as your portfolio goes up. But what happens if you lose money for 2 years in a row? Guess what? You still have to pay that fee. So if your money is in a 401k and then you have an investment advisor on the side with some other money that's non-qualified, you're just getting screwed from every direction. And people don't understand that. It's the lack of education. When I met Peter, I was amazed because he understood a lot of the things that we're talking about right now. Why we do this, why we're doing this blog, we're not trying to change people's mind. We just want to educate people to know the truth because, as they say, the truth will set you free. But try to find what we just talked about on the internet.
Mm-hmm.
Go ahead, try to Google all that stuff. Big money hides big money all the time.
So, Ken, let's say you are a just in finishing up this segment here, and then we'll move on. Um, let's say, let's say you're a 55-year-old, and you've done a really good job at saving and accumulating. Got a good job. You got $1 million in a portfolio between there, and you want to retire at 65. Let's just say $1 million in portfolio. Your fees are 4% for everything. 4% for everything. Over that next 10 years, we know you're going to lose twice. You're going to make up for it. You're going to have new money created. You're not going to make up for, the old money is not coming back, but new money will come in. We'll just say, right? And let's just say that the ending balance at the end of the game, right? The end of retirement went from a million, 1.7 million. You walk out 65, $1.7 million. Roughly, how much did the investment advisor and fees cost you combined over that 10 years?
If people actually figured it out, they would go through the roof.
About a half a million dollars. About half a
At
million dollars.
least a $500,000.
So think about that. Half a million dollars. That portfolio will be worth, even if we took half of that and put it back in, be worth over $2 million. That's how much for 10 years. 10 years, $500,000. That's why, I laugh because a friend told me this is like, yeah, visiting New York, driving around the island there, and you see all the brokers' boats and yachts in the harbor over there, but all the clients' boats are missing, aren't they?
Do you know where people used to laugh? We have to use when 401ks, clients used to tell us about their 401ks. And I said, hey, let me ask you a question. You ever see anybody get wealthy from a 401k, get rich? Well, I have $500,000. No, you don't. Let's talk about that, Peter.
Yeah, we should.
The biggest illusion, I got $1 million in my 401k. No, you don't. Well, at that rate, a person who's got $1 million is probably in the highest tax bracket too, right?
Correct.
So they're in a 39% tax bracket. You have $1 million in there. Guess what? No, you don't. You have $600,000. Let's put that in perspective. You were making $200,000, 150 to $200,000 a year. You retire, you have no write-offs anymore because you paid your home off. You're not putting money in your qualified accounts. Your children are all grown up. So you think your tax rate's going to go down. No. Believe it or not, sometimes it actually goes up, which is astonishing. But what else? You're losing that income on top of that. Now let's put this in perspective. A guy making just say $150,000 a year, he retires. He has $1,000,000. Hey, I'm good. No, you have $600,000 after taxes. Let's put that in perspective. That is $60,000 a year for 10 years, and you're out of money, or $30,000 a year for 20 years. That's with no losses in the market. That's the perspective people do not look at. This is the wake up.
And you paid $400,000 in fees.
Yep. On top of that. How's that for a kick in the... Now, let's take a look at this something. I am going to blow your mind right now. Say you bought a corporate bond, even if it was investment grade. I used to tell my clients, buy just below investment grade. Why would I want to do that? Well, the returns go from 2.5% to 4% to as high as 7.5%. But yet, only 1% have ever failed. Corporate bonds, people don't know that. But on top of that, here's the thing you got to understand. If you just had a bond portfolio just paying 4%, you would outperform every portfolio imaginable. It would blow a 401k away. Because what's the fee on the bond? It's built in. It's built in, and you know what the yield is going to be. This is the biggest illusion. So why doesn't everybody do that, Peter? How come people just don't invest in bonds that pay that well?
Because they don't invest in knowledge, Ken.
That's exactly right. What I just explained to you seems so overly simplified, but it's the God's honest truth. Pick.
Well, just so that we stay on track with our time this week, I want to move us on because we got a couple more points we really want to get across today. And let's talk a little bit more about the options trading. And we find this is so important to understand because so many of the whether it's day trading or whether it's Scott Trade, E Trade, all the other systems out there, Robinhood, they've all incorporating these option trading platforms and really trying to get this off the ground. And there's a couple reasons why. Obviously, the cost, number one, but the opportunity, number two. And that's really what I want you to hone in on here, Ken, is the opportunities that are generated. You spoke of it a little bit earlier about referencing the story with Kennedy about how the options work, but just hone in on this a little bit more.
Well, what some really smart people got together and they said, you know what? The market moves like this and we understand that, but it's two-dimensional, right? You can't really, they took away the factor where they can artificially push down the price of stocks. And they had that uptick rule. So what did they do? They came up a way to invest in the market three-dimensionally. So how did this come about? It's a really funny story, by the way. Regulators got together and they were sitting and talking. They were actually talking with Mr. Kennedy too at the same time. And the guy was kidding around. He says, we got to figure out how long an option is for and what is going to be the cost and how it's going to work. So the guy goes, let's do this. My wife's pregnant. Let's make it 9 months for an option. That's where it came from. God, true story. Options. What do they do and how do they work? Well, they're very simple in its simplest form. If you want the market to go up, you buy a call. That means you're betting that the market's going to increase. If you want the market to go down, it's called a put. But it's not that simple. You have to understand something. The price of the option is about 1/10 of the price of the stock, give or take. It depends on how long the option is because they have these things, leaps. And if what people don't understand about options is if you have a 5% move on options, you're probably going to double your money in that option. We'll say, how could you do that, Ken? It's just 5%. It's It moves incrementally faster. Now, let's talk about the downside. The downside to options is if you exercise that option and you're making money and all of a sudden in the last month and a half it takes a dive, guess what? You lose all your money. That is what people don't understand. Options are a great way to leverage your investment money, but it is not for the faint of heart. And if you don't understand how they work, you will lose every single time. I'm going to give you a quick example, and I don't want to keep on. I day trade options. I learned this from a 31-year-old kid. He taught me, the guy who's been trading for 27 years, how to day trade options. And all he taught me was discipline. What you have to understand, all of our investments, especially in the insurance industry, are based on options. Do you want to talk more about that, Peter?
I will in a minute, but continue with the story.
Okay. Oh, me? Okay.
Yeah, I'm sorry. Yeah, go ahead. No,
Okay.
you were just referring to the options and where we're going from here. The establishment once again was in the 70s, but like Ken said, why is it that people can make money in options? It's because it's leverage, and it's using that leverage in a positive way and taking advantage of the entire performance. Right? It's an incredible diversified investment opportunity. But let's just say the insurance companies participate in that because it's very successful. And ultimately, this is what we're going to talk about at the end here. But the markets, like you said, have been screaming to the highest levels that we've seen. Some of the longest bull runs in history, right? The last 100 years of the market. Why aren't people retiring with the money they thought they would have? And we've talked about some of those here: risk, fees, performance, lack of performance. And so overall, people are trying to figure out, how am I going to have enough money for retirement? And in looking at the history here, if you can see some things, there are some things that work. There's some things that don't work. And that's what we wanted to bring up. We wanted people to understand the history of, okay, why are there some alternative options to what the investment world would consider as the primary place to go for retirement? Why are there alternatives that are in place? Because of the failures of a lot of these systems. And I think I want to end on the asymmetric risk conversation just real briefly here, Ken. And this is for a lot of people who may not understand asymmetric risk. It is the risk, asymmetric risk is the concept of taking a risk that will produce the return that far surpasses the risk taken. And in essence, Ken, this is what you're talking about with options, correct? Is that
Absolutely.
you're exposing this little bit, and the potential is so much larger. But there are other contracts that also follow this principle of risk mitigation. And those are the contracts and the reasons why we represent the contracts, the companies, the carriers that we represent, is because they follow this principle of asymmetric risk, that the opportunities of putting a floor in and never being able to lose your principal or interest, even though we put that floor in, even though in some cases it might be capped at the top, it will still outperform the opportunity of the full movement of that market. And that's asymmetric risk. That's asymmetric risk mitigation. And then on top of it, the companies we represent take advantage of a very successful and a very lucrative opportunity with options. But guess what? This is not something that you can or I have to do on a daily basis. We don't have to day trade this. We don't have to figure this out. This is something that's done by professionals who get paid as mathematicians to understand which options to buy, which ones to exercise, what kind of portfolio to balance to give the returns to their constituents, to allow them to see returns that are making their portfolios double every 10 to 12 years. And that's why we work with the contracts that we do work with. Ken?
Well, here's what people learning comes into place. The brilliant people, they're not always the wealthiest people. They're just the people who are the most innovative, figured something out a long, about 30 years ago, that if you took options and leveraged your options, and if you bought a call, you want it to go up, and at the same time you bought a put, mathematically from history, they figured out that the worst they can ever lose on this side, the downside, and how much they can make up on the upside. Yes, you make less money that way, but when you're investing billions of dollars at a time, you just mitigated your risk. You literally mitigated your risk. That's why insurance companies can give those returns and have a 0 year. Because you have to say, well, don't they lose money? No, they don't. Insurance companies are the only companies that are A rated. I want you to take that in consideration. Microsoft's not, IBM's not, NVIDIA's not. Thinking about the biggest companies, they're not A rated. Why? They have debt and they have losses. Insurance companies have losses, but they know exactly what they're going to be within 3%. Sounds improbable? It's the truth. They know. Insurance companies lend money to banks. People don't know that. That's where banks go to get money. Using this portfolio. Now, I'm going to tell you why more people don't invest in these fixed instruments. Let me tell you why. One is the brokers on the investment side don't want you to invest in that. They want to manage your money and make their 2%. And they say, well, they have costs, they have this, which is ironic because nothing costs more than a brokerage account at 2%, right? Even if you're making money and losing money. But they were taking so much money, they started really giving them a bad name. The second thing is, and this is the horrible part, there are a lot of good companies and a lot of good returns with fixed products. But people want the juice. That's what we called it on Wall Street. They want the excitement. Fixed products aren't exciting. But
Mm.
I said this before, and it's the truth. And if you don't believe me, Google it. If you get 3% return, guaranteed, anyway, you will outperform every single thing in the market. You said, how could that be? Well, it's because of mitigated risk, what Peter was just talking about. You can't lose money. You can have a 0 year, but you can't lose money. This is so important that if more people understood that, Peter, what do we spend most of our time doing as financial professionals in the insurance world?
Educating.
And when we tell people what I just described and what you just described, how many people actually believe you?
A good number of them. They go, where were you 10 years ago?
I got to tell you something. I was an investment advisor for many, many, many years. I went to New York Life. I said I would never sell insurance. And then the guy says to me, this is how much you can make. I was like, okay, let's go. And then I had a really great mentor. This guy's, I wanted to say his name because I just love this guy. His name is Brian Van Blaricon. Probably one of the smartest men I ever met. He was my mentor for 3 years. He changed my entire outlook on how to invest. And he introduced to me whole life contracts. Now, at that time, there were no fixed indexed annuities. There was variable annuities and there was annuities that were immediate annuities. That's all there were at the time. But still, he showed me how to make people wealthy. He says you can make people wealthy just by using whole life insurance. And it took me a while. I was a Wall Street guy for many, many years. It took a lot of convincing, but he showed me how to mitigate risk, how to make people wealthy. And What's the greatest thing about life insurance? It's not taxable. That's the biggest factor people don't take into account.
Hmm.
It's not taxable. So, one of the things that when I met Peter, that we got along, we met through a mutual friend, a company, and I've been writing about insurance as investments for years. I wrote a couple books about it. When I met Peter, he was the first person besides Brian that I met that says he gets it. We can educate the public. We went and Peter's family started this company that we're with right now. And our whole job right now is to take what we know, all of our experience, and pass it on to the public. I hate when people lose money. I scream at people when I talk to them. If you're 55 years old and you got money in the market, you better rethink that. Well, how could you say that? You don't know what the future's going to bring. Yeah, history will tell you everything. History is where people don't learn from. If you start converting into fixed products and you're getting a return constantly over a 10, 15-year period with that money that you already accumulated, think about where you're going to end up compared to a taxable. Peter, why don't you tell them? I don't want to go deep into it, but what are one of the things that Peter and I really like talking about is a Roth conversion. I don't want to go deep into it, but could you explain that to people?
Well, I think we're just about out of time here today, but we will definitely have to have another video on that topic very shortly here to go over the value that we can bring to people in their retirements to deal with some of the issues that Ken was talking about earlier. That if you had that $1 million portfolio, there's a way for us to mitigate that. If you use some of the tools that are available today, we can actually use other people's money to help mitigate the tax consequences between a traditional account and moving it into a tax-free vehicle. And that's part of the conversations that we have. Some of the tools, if obviously if they're appropriate, but there's just so much that we have to offer people. We just wanted to really today give a very broad overview of where this conversation came from as far as investing, the concepts, the history behind it, and bring you down to these 2 points. We use the companies we use, the contracts, the products, the solutions, because we know they work. Because even inside Wall Street, they're using very similar, if not the exact same instruments to be successful. All we're doing is adding the risk mitigation, the same options trading with a different crediting method in order for our clients to receive the same kind of performance, but with more securities, more guarantees, and with the retirements that they deserve at the end result. And that's really what we're trying to do here is help people understand why, with all the knowledge that Ken has, with everything that he's seen from Wall Street to investment banking to working in all these sectors, why is he here today as a financial professional selling insurance products? Well, Ken just gave you a kind of a brief history of why. And as we traveled through the different aspects of our history, why did we wind up here? There's a reason, folks. These things work and they're time tested and proven. And that was today's goal, was to show you why the solutions that we represent are, in our opinions, the best solutions to bring to the general public. I'm
Before we
Peter.
go, Peter,
Yeah,
I
go
want
ahead.
to ask you one question. I want you people to think about it. Who's the largest purchaser of life insurance? I actually learned this from you. Banks are the largest purchaser of life insurance. That's for another day.
Well,
Peter,
because you opened that can up, let me give them just a hint of an explanation. Tier one assets. Tier one assets. There's only a few tier one assets. These are assets that cannot be leveraged. Beg to differ on a little bit of that, but they can't be leveraged to the point where they have no value. That would be treasury bonds from the US government, gold and silver, and cash value held in life insurance contracts are the four main hedges that banks are authorized to hold cash in a cash reserve position by the Federal Reserve. They're limited, according to Bretton Wood, they're limited to how much they can put into their tier one assets. At this point, they're allowed up to 27%. So, just so people understand, we're talking about billion-dollar companies, and they put 27% of their holdings spread between government bonds, insurance accounts, and in some cases, gold. That's why we use these folks, because the smart money, they're already using it. They're just not telling you about it.
That's why we came up with that term, follow the money. If you just follow the wealthy people, you wouldn't have to guess anymore.
Mm. Ken, thank you very much for your experience. Thank you for their stories and all that you shared with us today. I really appreciate it.
Thank you, Peter. And I'm looking forward to our next week. We're going to have a different subject. Please watch us. All we are here to do is to help people have better choices. That's why we're here.
And from Main Street to your street, we want to thank you again.
Thank you. You all have a good weekend.